Hello dear traders, welcome back. Yesterday was the first Friday of the month. On every first Friday of each month, the NFP data is released. So was released yesterday. I'm sure it would have blown the accounts of many of traders, especially the new traders who don't know how to trade the NFP data, and they were willing to make some quick profits in the market. So if it is the case with you, or it doesn't matter if you are a new trader, experienced trader, or profitable trader, this insight about the NFP data will give you an upper hand on the market to trade the NFP data more accurately next time. So stick to the video till the end, give me thumbs up and subscribe to my channel. I have opened a gold chart, but before I explain any technical terms, I will take you to the economic calendar to show you the data. So the high impact news you can see on the 5:30 p.m. in our country. All these news were released at the same time. The average early earnings, the non-farm employment change, the unemployment rate, and at the right we can see all these data were negative for the dollar, or too much negative for the dollar, which means it as a result would be positive for gold, for stocks, for cable, Euro USD, AUD USD, and NZD USD. So now let me take you to the chart. You would be asking, if all the data were too much negative for the dollar, it as a result were positive or bullish for the gold, then why it didn't break the all-time high? What went wrong? So let's move to the lower time frames to show you the exact times when the data was released. This green up close candle was the time the NFP data was released, and when the data was released at this time, most of the traders were waiting for the market to make a pullback move. So most of the traders were buying when the market was making this move to the downside, a pullback move, because they saw the economic calendar and they saw all the data is too much bullish for the gold to break the all-time high. But then the market reversed on them, and probably they would have set their stop losses below this low, because this is what is taught in the retail trading. To the retail mindsets, the stop loss is usually placed below the low or below the support. So now if the market was making this move to the downside, most of the traders were buying the gold market or the other pairs. Why? Because they knew the data is too much bullish for the gold and for the other markets. So they would have placed their stop losses below this low. Okay, the market also took this liquidity, which was the sell side liquidity. Now they were buying again, and they were anticipating that the market will break the all-time high. The market will move all the way to the up, but it was not the case, and it is usually not the case, because the NFP data is used as a smoke screen by the institutions, by the hedge funds, and by the smart money to trap the retail traders. So what was happening when the market was coming to the downside here? Again, most of the traders were buying at this point too, and where they were placing their stop losses, they were placing stop losses below these lows, or first of all below this low. When this low was broken, they were still buying the market. They were placing their stop loss then at this point, and finally the last point for the stop losses was here, and we saw all this liquidity was cleared, was taken, and all the stop losses were taken by the market. And from where it returned from this fair value gap. Okay, the fair value gap is consequently encroached. What is consequent encroachment? It is the 50% level of the gap, that is consequent encroachment. But this move happened later when the upside liquidity, when the buy side liquidity was taken. So I will explain from the very start that why the market reversed, why it didn't break the all-time high, why it didn't give a chance to the buyers, to the new traders to buy the market. Let me explain it from another perspective. Now again, on this up close candle the data was released. So what is happening? What is resting above this high? Okay, most of the traders would have sold the market, and most of the traders were in selling positions before the NFP data was released. They were anticipating the market to move to the downside. So what would have happened? They would have placed their stop losses above this high. The NFP data was released. The market took this high. The market took liquidity from this high. So it is now in the M15 chart. Let me explain it in the early chart too. Okay, this was the area I was mentioning, that the market took liquidity from this point. At the same time, here was a previous high. And we can see the wick going through the high, the previous high too. So if a trader has placed his stop loss above this high, the market also took his stop loss. The market also ate that one. So that's how the market took the buy side liquidity. And one thing extra I'm showing you from where the market reversed. Give me a minute so you will have the better understanding of how this NFP data works. But remember one thing, the positive data, the negative data, that doesn't matter. That is all used as a smoke screen by the smart money, by the institutions, by the hedge funds, by the banks. So never trust on the data. This is how they trap the retail traders. So I'm taking you to the previous to the all-time high, which is at this point. This is the all-time high. The green candle, the up close candle, we will consider it indeed it is a bearish order block. Now let me zoom in a bit. The green candle, we will pull out the Fibonacci retracement. I will draw it from the high of this green candle to the low. You can see it, and at the 50% level of this candlestick, which is the mean threshold, the 50% level of every order block is considered the mean threshold. So let me draw an horizontal line on the mean threshold of this bearish order block. Okay, now let me zoom out and show you. This was the exact point the market reversed. See, not even a tick above this, above the mean threshold of the bearish order block. So this is how the market reversed. It took liquidity, the buy side liquidity, and when the market was, the traders were anticipating the all-time high to be broken, they were buying at this range, all the traders were buying, where they were placing their stop losses, probably as they are taught to place their stop losses below the lows or below the supports. So their stop losses are usually placed above the lows. The market took the stop losses at this point. Now again they were anticipating the markets, they were still anticipating the market will make an higher high, so they were buying. In all this phase the traders were buying. To which extent they were buying? They were buying at this area. Why? Because they were having a strong support, relative equal lows. This is considered a strong support in the retail mindset. So they were having a strong support below, and they would have placed their stop loss below these lows. So when the market took their stop losses, again they were buying at this point. Why? Still they were having a support, a low, and they would have placed their stop losses below the low. When the market took these lows, these stop losses, they were still buying at this point, because still they are having this low to place their stop loss below and these lows. But when the market took all these lows, that was the time the smart money was buying. And where they were buying in the area of the fair value gap. Now, as it was the perfect time for the retail traders to buy, all the traders were discouraged, they were disheartened to buy the market anymore. So the smart money was taking advantage of this scenario, and they bought the market, and as a result there is something extra I will want to add. When the market was making this pullback move, so now the traders that were panic buying at this area at the start, I mean at this point, those traders were selling again at the pullback move, and where they would have placed their stop loss above this high. So again the market played with them, the market took their stop losses again. So this is what happens in the market during the high impact news, especially at the CPI and NFP data release time. So always consider these data as a smoke screen used by the smart money to play with the retail mindset, and never trust the data too much. No matter what happens, if the first liquidity, it could be either to the upside, it could be either the buy side liquidity, or it could be either the sell side liquidity. When the first liquidity is taken, that is the time you enter the market and you target the opposite side liquidity. and when the when the sell side liquidity is taken first, so it will prolong the market to move to the buy side liquidity. It will prolong the move as the market prolong. First of all, let me remove the noise. So as the buy side, which was taken first, prolonged the move to the sell side, and it was with the fact that the data was too much positive for gold and for all the other markets in which the USD was in the quote currency and not in the base currency. So this is what happens. So if the data was too much negative for the gold, what would have happened? The gold would have took the liquidity first to the downside, okay, and the exact opposite would have happened as to the yesterday scenario, and then the market would have turned to the upside and the move would have prolonged. The move would have prolonged to 500-600 pips. So guys, this was all about the NFP data and how it works without the data being too much positive, too much negative. That doesn't matter. It is always used as a smoke screen for the retail traders. So never trust the data again and trade it this way when first side liquidity is taken and it reverses. So when it reverses, it will prolong its move to the opposite side as it happened this way. I hope it was insightful. Till talk to you to the next time. Take care.